Well, evening to our fourth class. No, we're making progress. Uh, we are talking, or you've been thinking we'll be talking about other, I guess, disclosures that companies make that will accompany the financial statements. And the key one that we've been thinking about, and I got you to think about in the discussion forum, was this idea of non-GAAP or pro forma earnings. And they've become relatively ubiquitous. So in the ballpark of, I know on the ASX, it's kind of upwards of 60% of listed companies will provide these. I don't have a percentage number for US firms, but it would not be that different from that. Um, and so by non-GAAP or pro forma, we mean earnings or performance measures that are not conforming to the specific accounting rules that the GAAP numbers are provided. So there's some adjustment. And so the kind of the key words that you'll be looking for these would be underlying, so underlying profit, underlying EBIT, underlying EBITDA, adjusted EBITDA, normalized or core. So there'll be some adjective that will go along with the performance measure. So you had a look and most of you found a non-GAAP or a pro forma number for those that were posting in the discussion forum, kind of asterisks. I realized what was brought to my attention that we had that and the assignment due were kind of roughly the same time. So I've left the discussion forum open for an extra day or so. If people want to put something up there, that's going to be fine. The assignment, I guess, is more time critical than the discussion posting. So I'm happy to do that. So companies provide a performance measure that is different to the rules-based measure. Okay. So I guess the obvious question is, yeah, well, why? And is this good or is this bad? Two schools of thought on the why. What do we think? Give me either of the schools of thought. So either based on what you've read, what you've thought, or if, let's say, you're running a company, you've got the opportunity to provide a performance measure. Why might you provide a performance measure that differs to the rules? So Cora said to standardize. That would be one. Yeah, I standardized, I guess, to what?
So I guess, for example, when it comes to EBITDA, that it's independent of capital structures. So there'll be kind of a standardized measure of revenue across businesses in
Yeah,
the same industry.
yeah, and EBITDA is a common one that that people and there's some. Oh, let me step back. So is EBITDA a non-GAAP performance measure?
It is, right?
Yeah, it's kind of one of these weird ones because it's not we can usually, if EBITDA isn't an explicit line item on the income statement, we can normally calculate it from line items on the income statement. So we can get an operating profit or an earnings before interest and tax. And as long as we can find out depreciation and amortization, then we can get EBITDA. So for everyone, earnings before interest, tax, depreciation, and amortization. So it's kind of a funny one because it's not a bottom line measure of earnings or an operating profit. And so it kind of depending on how wide or narrow we're forming a view on non-GAAP earnings, people will fall into different camps on whether sort of a measure like EBITDA is non-GAAP or not. It's not a measure that is defined by the rules, but it can be but it's calculated in accordance with the rules. So I would describe, say, EBITDA would be a number that we can get from the rules-based numbers. Adjusted EBITDA would be a kind of a true pro forma or non-GAAP measure, is the kind of the way I think about it, at least.
Okay.
Yeah, and so just looking at what's coming up in the chat, we've got a clearer performance where the GAAP results are skewed to highlight to highlight non-recurring items and impairments. So though both of those, so if GAAP results are skewed, or we want to highlight a number where we take out non-recurring items and impairments, that would presumably, both of those, the argument here would be is that the non-GAAP measure is likely to be, at the very least, informative and potentially more informative than the GAAP number. Is that like a fair way of describing it? So non-GAAP is helpful to people looking at it because it either adjusts for issues with GAAP or adjusts for issues with, I guess, the business model as reflected in GAAP, so the non-recurring items and impairments. And certainly a lot of businesses that provide non-GAAP measures provide them because they say, look, the GAAP rules don't allow us to present a good or realistic view of the underlying economics of the business. And the kind of every year when we look at Warren Buffett's letter, for example, he says, look, our GAAP earnings are X, but what I really want you to look at is the operating earnings because that reflects what we've done as a business. And so the idea, so what makes non-GAAP earnings potentially useful is it can provide a better measure of the economic performance of the business. What's so potentially good? What's the potentially bad side of non-GAAP earnings?
They allow management executive to, it could potentially deceive the readers of their reports by presenting a picture that's not accurate.
Yeah, and so that's a good way of summarising it. Yeah, so the concern with non-GAAP is that if managers are coming up with the performance measure, then they might try and provide a performance measure that paints them in a better light than is warranted, let's say. So that's one concern. So it could be used to mislead. I guess the other way, if we go back and so if we're thinking about kind of comparability and the extent to which we can kind of look at, I guess, comparability in two dimensions. Concern with non-GAAP is one, is a company, so is Qantas or is BHP or is whatever company we're looking at, is a company looking at this, are they making the same adjustments year by year? So is there time series comparability? And the other one is Qantas making the same adjustments as Virgin? So is there cross-sectional comparability? And the answer to those questions is, well, not necessarily, and it depends. Cross-sectional variability is, we know that there's been a lot of research done that different firms within the same industry will make similar but not exactly the same adjustments. Auditable frameworks. So at the moment, to answer the question, Omen, no, it's not. This is just something that firms can produce. There is guidance on what you should produce, and the guidance from depending on what stock exchange you're on, or whether it's the SEC or kind of ASIC as the corporate regulator, the guidance is if you provide a non-GAAP earnings, you should provide a reconciliation between the non-GAAP and the GAAP. So users should be able to work out what you did to get from sort of net profit after tax to underlying profit, if that's our number.
That follows another stupid question. So if I'm about to sell my company to an party, I can skew GAAP showing operations are wonderful, non-GAAP.
You can. And so what if the potential purchaser of your company they would say, look, obviously we want to see the gap numbers as well. And an obvious question then to you as someone selling a company would be, so why have you made these particular adjustments? Yeah, so it would kind of be, it would be buyer beware on using the number. Yeah.
But it happens, right?
Oh, yeah, it happens a lot. I popped up, let me just get for you. So here's an article that I popped up on Moodle recently. Let me just hit share, get this one up for you. Our favorite Mexican fast food chain, Guzman Gomez, who recently went public. Let me just see if that will get a bit larger. And they were looking at, well, they provided kind of pro forma numbers, which is kind of like the same as a non-GAAP number in its IPO prospectus, kind of along with WeWork. Elena, question, hand up there.
Yeah, I was just going to ask on that. So when the external auditors check the statements, do they then not check the non-GAAP numbers at all?
Yeah, correct. You can, yes, because what the auditors are going to sign off on is the financial statements and the kind of like the notes of the financial statements. And one of the things that I was that I've been meaning to raise is that it's typical that these non-GAAP numbers will appear kind of in the management discussion section of the annual report, which is kind of like not audited, or even more commonly, it will appear in the earnings kind of investor release, the sort of the set of slides that goes out at the same time as the sort of the audited financial statements.
Yep.
Now, and as I said, it's currently, they are not rules-based. What I'll show you is kind of what IFRS at least is planning on doing as of 2027. So I'll just make a note that I will go to the document that I've got there. So the Guzman and Gomez in their IPO prospectus were putting out a pro forma earnings number that excluded some of their lease liabilities, so they were looking at an earnings before interest and tax-based number, or an earnings before interest, tax, depreciation, amortization, which is kind of an interesting one, because it wasn't that they were making adjustments to that particular measure. It's just that the way the accounting for leases works now, and obviously Guzman and Gomez do a lot of leasing of their stores, the expenses associated with leasing, I think, is a relevant expense for us to be considering when we're trying to work out what the performance of this business is. It's an important expense. So it's the sort of the second biggest by line items. What would have been the case 6 or more years ago, before they changed the leasing standard, was that the leases would have been reported as an operating expense. So it almost certainly would have been an operating lease, which didn't appear on the balance sheet, and therefore would be on the income statement. Whatever they paid in their rental expenses would be rental expense or operating lease expense. And so that would be in their kind of above the line, or their earnings before interest and tax, or earnings before interest, tax, depreciation, and amortization. So part of what was going on here is the fact that the leases are now classified, what would have been an operating expense 6 years ago is now classified as kind of the interest expense, is what they're going to be reporting on the income statement on their lease liabilities. So it's classified as part of the financing rather than operating, kind of, even though it's in nature, it's an operating expense. So that's one of it's misleading to the extent that I think it's an important expense in understanding the business, but the way the accounting rules are is it's not typically, it can legitimately, in accordance with the rules, be classified as an interest or a financing cost rather than an operating cost. So that's kind of like a quirk of the way that the lease standards kind of ended up working. So I've popped this up on Moodle for you. The other document that I'd popped up here, someone was discussing stock-based compensation, and so stock-based compensation is commonly excluded from our non-GAAP earnings, particularly for kind of US firms. The argument being is that because it's not cash going out of the business, it's not an expense that investors would need to worry about. And there's been debate about this for decades now. Part of what the issue is okay, so is this something that I can legitimately exclude if it's a non-cash based expense? And a couple of arguments one is that it is diluting the existing shareholders' holdings when these options or when the stock-based compensation is exercised or issued. So on a per share basis, you own less of the firm as a shareholder because more shares are being issued. And so your per share claim on the earnings of the firm have gone down. And so in that sense, it is kind of, it's because these things are dilutive, then that is a problem. But that it's a common exclusion, particularly in the US. The other document that I was going or thought I'd put up, here we go. And it's this document here. So if I can make that a little bit larger for you. In 2027, so this is a new standard that will be effective 2027. And it's going to do two things. It's going to, one, change the way the firms have to present their income statement. And in particular, what it's going to do there is that rather than, at the moment, firms have there's a wider range, or wide number of ways that firms can present their income statement. It's not particularly standardized. You need to show tax expense separately. You need to show financing expenses separately. But beyond that, there's a fair bit of flexibility in the way that you can present your earnings under IFRS. What's going to happen in 2027 is that firms will need to present their income statement in three categories. It'll be operating, investment, and financing. And so that will, again, if we think back, okay, well, that sounds like that it matches what we see with the cash flow statement presentation. So we know we've got cash flows from operating, investing, and financing activities. The income statement or the P&L is going to match that. So I'll have income from operating, investing, and financing. And the sort of the investing is going to be it'll be slightly different to the investment activities, the way that we think about it in the cash flow statement. Because remember, for the cash flow statement, the investment activities are purchase and sale of the non-current assets that the business uses to generate money. So buying and selling property, plant, and equipment, for example, buying shares in other businesses. The investment activities on the income statement will be the income that you generate from your non-operating activities. Okay, so can I give you an example of that? A lot of the tech companies, Apple's a good example. If you have a look at Apple's balance sheet, and have we looked at that in previous weeks? Well, okay, here we go. Let's go to Apple 10K and 2020. Okay, so this is kind of like there are more recent, this is the last annual report that they've got. So this is Apple Computers. And if I go down and I'm looking at the financial statements, risk factors, financial statements and supplementary data, and I'm looking at the balance sheet. Okay. let's look at Apple's balance sheet, and I'll just see if I can make this slightly larger for you. Might have to make that slightly smaller. Can we see that? Is that
Yep.
kind of okay? Yep. Okay, so I'm looking at the assets. So total assets, we're in millions. So I've got, millions. So we've got 300, and let's round it to $350 billion worth of assets. Okay, fine. Except what makes this difficult to analyze in terms of how well Apple are doing, have a look at the composition of the assets, sort of both the current and the non-current. So of that 350 billion, well, the first line item, 30 billion, is what we've got in the bank account. Another 30 billion is marketable securities. So that's government debt, corporate bonds, and so on, that they expect to realize in the next 12 months. So we're up 60 billion of cash and marketable securities. Look a bit further down to the first item in non-current assets. We've got another $100 billion worth of marketable securities. So in other words, we've got 160 billion of the 350 billion is what I would describe as non-operating assets. These aren't things that Apple are using to generate or make their iPhones with. So what kind of, if they're reporting under IFRS, the rules would then require them to do and say we will have the iPad, iPhone, the computers and the phone and the Apple Store income would be part of the operating income. The dividends and the interest that they get on these marketable securities and the cash holdings would be kind of the investment, or the holdings on the marketable securities would be investment, and any kind of interest that they get on their bank accounts or any, if they had loans, any interest that they paid on the loans would be part of the financing. So that's the way that Apple would have to do that. So the marketable securities that give rise to dividends and sort of the T-bills that they generate, that will be part of their investments rather than their operating activities. So this is, thinking about the extent to which the balance sheet does a good or a bad view of reflecting the underlying economics is kind of part of what we think about in our financial analysis. But that's where, or an example of what at least the IFRS standard is trying to address. So where they're doing two things there. One, they're going to be showing how we've got operating, so you can see on the right-hand side here, operating, investing, and financing is what will be happening in the profit and loss. Margarita.
Are there any rules in regarding to which securities can they invest in, or can they just invest in any, I don't know, stock that they, or equities that they?
Whatever, that's a kind of a management decision. They can invest in whatever they want. One of the reasons, because those numbers obviously, well, when we look at them, they certainly seem large to me. It's like it doesn't seem like there would be a good capital allocation reason for Apple sitting on $160 billion worth of these materials. And part of the reason why it's a lot of the US-based multinational tech firms that have these really large cash balances. Part of that comes about because of the way that the US tax code is written. Historically, up until kind of there was a reduction in the corporate tax rate under the previous administration. But prior to that, the US had a corporate tax rate of 35%, which on a global scale was relatively high. The response from a lot of these multinational, particularly the multinational tech firms that are sort of spitting out cash at the moment, is that they will locate a part of the revenue generating parts of their business in low tax jurisdictions. Ireland, for example, is popular. The Netherlands is popular. And this is part of what the tax folks talk about as base erosion and profit shifting. So as BEPS has been a long-standing issue that the global tax administrators are trying to regulate, so that the companies sort of pay their fair share of taxes in the jurisdictions that they are earning the income. So there's a lot of profit shifting going on to try and minimize tax. What the US tax code says is, if you earn profits in a jurisdiction that, let's say, is taxing corporate profits at 10%, and the US tax, if you earned that in the US, it would be 35%. We are going to tax you the marginal 25% anyway, except if you can demonstrate that you are, quote, permanently reinvesting those profits overseas. So that's kind of like the test that the US tax code makes. One of the ways that companies then decided to try and demonstrate that they were permanently reinvesting is by buying government and corporate bonds in those overseas jurisdictions. So that's one of the, so it's a tax-based driven rather than a kind of a capital allocation decision that's led to kind of massively large amounts of marketable securities on businesses that really don't need them for the proper kind of liquidity and solvency functioning of their businesses.
Yeah.
And occasionally the US will have tax amnesties where you can kind of repatriate some of these profits and not have the tax penalty. Because as a shareholder, if I'm a shareholder in Apple, I want Apple to be making products that are popular in the market and sell at extremely high profit margins. I don't necessarily want them sitting on a pile of low risk and low yielding sort of treasury and corporate securities. If their operating profit margin is 40-something%, then I don't want them to be getting 2% on treasury bonds. I would sooner them get the money back to me and I can invest it in someone else who might be able to get 40% operating margins. So it's an ongoing debate about the sort of capital allocation versus sort of this permanently reinvested overseas earnings. So I guess that's part of the background as to why this happens, because it's not an obvious, it's not necessarily obvious why they do that, because they don't always flag that.
Thank you.
Yeah, and just kind of back to the other part of what's going on in this IFRS 18 that's going to be released is, if I go back and I'll share this document. So on the one hand, they're regulating the way in which we present the P&L, but the other is going to be important is what we've been calling pro forma or non-GAAP earnings. IFRS has decided to call management defined performance measures. And this is now going to become subject to the IFRS standard. So back to the question that I think Omar had just posted in the chat saying, look, are these things regulated or audited? Under IFRS, they will become part of a regulated disclosure. And so the auditors then will have to look over those. And so this is, as I said, this is coming, sort of effective 2027, which will kind of come faster than we all imagine. So no current requirement to get those numbers audited, but will be subject to the kind of the IFRS rules down the track. So I flagged what's potentially good about these non-GAAP or pro forma or management defined numbers is, on the one hand, it can allow managers to say, here is the performance measure that we believe best captures the underlying economics of the business. And therefore that's informative. So I said, the potential downside is it might be used to mislead. I didn't put much of that in kind of in our material. The research that's out there is, which kind of the stuff that I look at, which tends to be the large sample on average evidence. So when we're looking at a large sample of firms over time, on average, what we find is the non-GAAP numbers are more informative to investors than the gap numbers. And the way that that's tested is the people effectively run a horse race between the non-gap and the gap number and an alternative measure of performance. And the alternative measure of performance they use is what's happened to the stock return over the year. So they're saying, assuming that the market is a fair measure of what's happened, does the market seem to respond more to the non-gap or the gap? And the answer to that is, on average, the market responds more to the non-gap. So there's a higher association between the stock return and the non-gap than the stock return and the gap. It could be, so two explanations. One, the gap measure is a better measure of economic performance. Second measure, investors are fixated too much on this non-gap measure and just focus on that. And it's hard to kind of unpick those. But yeah, on average, they seem to be informative. On the question of whether the non-gap numbers are systematically designed to mislead, I did a bit of research on this a while ago for a monograph that ended up being published by Chartered Accountants Australia and New Zealand. And when we were looking at this in Australia, we were expecting sort of one of the things that we did was, okay, let's take the non-gap number and compare it with the associated gap number. So if they're talking about underlying profit before tax, we would look at gap profit before tax. If they're looking at underlying EBIT, we would look at gap EBIT as the measure. And one of the things that we're interested in is, to what extent was the gap or the pro forma number higher than to what extent was the non-gap or the pro forma number higher than the non-gap? Keep getting this mixed up. You know what I'm saying, I hope. To what extent was the manager-defined measure higher than the rules-based gap measure? Is the question that we're looking at. And we're expecting the management-defined or the pro forma or the non-gap measure to be, my prize, I would have bet 85 to 90% of the time it would have been higher. Now, it turns out that was only the case about 60% of the time. And we know that the non-gaps often are excluding certain types of expenses, like the equity or share-based compensation. So that number struck me as kind of relatively surprising. So on at least 40% of occasions, the management defined, so the non-gap number, was lower than the associated gap number. And what firms were doing is saying, look, one of the common exclusions was when the accounting rules changed to a more fair value rule for certain assets. If assets are being marked on the balance sheet at fair value, value goes up, we report income. Value goes down, we report a loss. They were excluding those gains or losses on the effectively unrealized profits on marketable securities that they were holding. But they were doing that consistently. So they weren't including gains and excluding losses. They were being consistent with the way they were doing that. And so that was somewhat surprising to us, that in a much higher percentage of cases than I would have expected, the non-gap numbers were in fact lower than the kind of the associated or the matching gap expense. But there is still it's problems that I find with them is it can often be difficult to work out exactly what's gone in the exclusions or what is the adjustment. And it's certainly not clear that firms are doing the same adjustment kind of year by year. Some firms are relatively consistent. Qantas is one that I keep looking at year after year, and they tend to be fairly consistent about the adjustments that they make, but they're not the same adjustments as Virgin. And if I go back and look at the adjustments from 10 years ago, they're not exactly the same. So there is still somewhat of a lack of comparability. When we talk about equity security analysis later in the term, the analysts will often be forecasting the sort of the non-gap measures that the firms are providing, and because this is the sort of the language that the firms use when they're talking to the analyst, which is something that hopefully you might get to see some of that to the extent that your firms are using any non-GAAP that you might see for the sort of the second assessment that you're giving me, which is where you kind of are going to be listening to the conference call and giving me some feedback on that. So on that, yeah, on those non-GAAP earnings, any thoughts, questions, comments at this stage?
I have a
Yeah.
question.
Sorry. I was just looking at Christian's point. Does the level of consistency depend on management? Yeah, it does. It's, as I said, because at the moment it's unregulated. It's up to managers. I guess to the extent that you believe that it is a more informative number, then you probably want to try and convince investors that of why that is the case. And here is what we're going. Here are the adjustments that we're going to make. Yeah, who else is about to jump in?
Oh, that was me. You have already answered.
Yeah.
Thanks.
So back to if there's the question that you posted on the chat, yeah, there's no guidance as to how you should be doing it. But yeah, not audited, not regulated at the moment. Is kind of where it.
Yeah, this was a question I was going to ask, but then Christian mentioned that and you kind of answered it, but I'm going to go back and still ask the question regardless. So I've done AICD's course, studied accounting and finance, and there has been no mention of GAAP in any of the accounting way of looking at financial statements in any of those courses or those materials. So what I'm concluding here is a non-GAAP methodology is a purely manager's own consent or its own will to declare it's completely, and it will be changing from one company to the other company, and this is essentially a glimpse to their operations, telling us how well they're playing their strategies and how much they have to adjust and not adjust. So if their adjustments are less, it means they're doing good or bad. So
yeah, okay. So this goes back. Yeah. So the underlying motivation for doing this, and that's actually good and is worth us thinking about that for a second. So way back earlier in the chat, let me have a look. Peter made the point, look, to provide a clearer picture of company performance where the GAAP results are skewed. And so part of the answer to your question, Omar, is that we might be expecting more non-GAAP or a higher level of adjustments in industries where we think that the GAAP rules are less rather than more informative. And so for an example, if you're a business that holds lots of marketable securities, and sort of the Warren Buffett Berkshire's our go-to example here, part of what's going to be in your income is these gains or losses on the movement in the shares that you own. Now, again, the Buffett argument is that we hold businesses long term. We're not day traders. So any year by year change in the share price is not relevant to our performance at picking stocks. Our performance at picking stocks is, have these businesses been generating good operating earnings that they will then pay to us as dividends? And so they say year after year, ignore that gain or loss on the movement of marketable securities. That's not a good measure. So the more you hold those types of assets, for example, the more you might expect to have a non-GAAP measure. It also depends on the nature of, if, for example, firms that provide EBITDA as a measure, let's think about EBITDA rather. So if we're working our way back up the income statement, I'll see if I can find, if I've still got the IFRS document open. If I can go back up, let me just try and share this. So by going back up the income statement, I mean, so we've typically got, if we sort of start off, we've got revenue, we've got cost of sales, or what used to be cost of goods sold. Let me just see if I can make this a bit larger for you. And that might be a little bit easier. Okay, so revenue less cost of sales gives us our gross profit. We've got other operating items, including R&D, general administration, other operating expenses, to get us operating profit. Then, and this is what firms will have to do but don't currently do, after operating profit, what we will get is something along the lines of other income or loss. Then we do get financing costs and our tax expenses. So we've then got kind of a net profit after income and after interest and after tax. So when I say when we go up the income statement, so operating profit is usually the same as earnings before interest and tax. So EBIT and operating profit are usually interchangeable. Then if we want to go from EBIT to EBITDA, then we would find the depreciation and amortization costs that we've got as part of these other operating expenses and add those back. Now, if we're thinking about what do these numbers tell us, and which goes back to I guess the point, if I want to try and make my business look more profitable, I will kind of just exclude more and more expenses. So if I'm going to try and sell my business to you, I might use EBITDA rather than net income multiples, because I will get, by construction, a higher multiple. I guess the issue is why or under what circumstances might EBITDA or an adjusted EBITDA be more informative than EBIT, than be more informative than net income? I'll have a think about that for a second. So I'll say that again. What's the difference? So what are we learning about the business if we're looking at EBITDA versus EBIT versus, say, net profit after tax?
Losses. We know how much losses they have because taxes reduce if the losses increase. So EBITDA is complete. Earnings are complete simple earnings. And then EBITDA is earnings before income tax depreciation.
Yeah, or interest, tax, depreciation, and amortization. Yep.
So what it tells me.
Yeah. Sorry. Go ahead.
So the difference between the two is losses. So if the business has made losses, that would be covered over those taxes.
Yeah, and so typically, if we're kind of depreciation and amortization are expenses, so they make income go down. Yep. Tax is an expense, well, typically an expense. It should make income go down. Financing, depending on the sort of your financing model, but typically it's financing as a net expense rather than net income. So typically these are all things that make income go down. But I guess what it's telling us about is, I guess, different levels of how the management team has performed. If we're kind of focusing on the day-to-day operations, then an EBITDA measure, you might be able to argue, is going to be a better measure because it's excluding a whole lot of the non-operating day-to-day stuff that the management team might be engaged in. So, and a couple of ways of thinking about that. So, the depreciation and amortization is going to be a function of this year's CapEx and many prior years' CapEx. So that's not something that's part of my kind of short-term operating performance. Depreciation and amortization depends on the decisions of prior management or current management in prior years. So if we're trying to get a short-term evaluation, that would be my argument for excluding depreciation and amortization. And organizations that do this when they're trying to sort of show how they've done this year or in their short-term incentive plans, this is where EBITDA is often popping up, and I think you can make a legitimate case for that. So depreciation and amortization depends on past CapEx decisions, not necessarily this year's performance of me as a manager. Now, so EBITDA is kind of closer to our day-to-day operating. The finance folks will also say it's closer to cash flows, so there's less accruals that we can manipulate. And we were thinking last week about this kind of idea of accruals versus cash flows and what could be manipulated. Because net profit relative to sort of cash from operations. It's kind of just slicing our kind of cash flows into different accounting periods. So EBITDA, excluding depreciation and amortization, which is a function of CapEx, also excluding interest. And the argument here is that, look, my interest expense is going to be a function of the capital decisions that have been made, so the financing decisions that have been made in terms of kind of the capital structure, the debt equity mix, probably in prior years, but maybe to some extent in this year. But it's not a kind of a short-term year-by-year operating decision. So it's a longer-term solvency and liquidity issue as the way in which we finance the businesses, and are we doing that appropriately? So again, if we're using this as a short-term measure of performance, then that would be my argument for why excluding interest would be okay. Excluding tax might make sense if, for example, we're looking at evaluating the performance of, I don't know, divisional heads or business heads. If we're looking at, say, a JB Hi-Fi that has JB Hi-Fi Australia, New Zealand, and the Good Guys, or a Wesfarmers that has a whole bunch of different divisions. The reason being is that tax is assessed at a kind of consolidated group level. And so the tax expense may not be reflective of my performance as a business unit manager in a particular year. So that will be my kind of argument there. So the EBITDA, more likely to pick up short-term operating performance. EBIT, earnings before interest and tax, is picking up a short-term operating performance with the longer-term impact of the prior CapEx decisions. Net profit after tax is picking up the performance of the business when I'm taking into account all of the, I guess, long-term strategic management decisions that I could be taking. Does that kind of breakdown making sense? So it's the whether which performance measure is appropriate or not is often going to depend on what we're trying to do with it. And that's part of the problem, is that in some cases, these performance measures get included in the short-term or less likely a long-term performance measure as part of your bonus contracts. The other thing that we'll get to kind of later in the term is that multiples based on EBITDA or EBIT or net profit, or if we don't have any of those, on revenue, often form the basis of what the amount of money that's paid in an acquisition. So valuation multiples are typically made off, so I said, a multiple of EBITDA or a multiple of EBIT or a multiple of net profit. And so again, if you're thinking about buying a business, you want to be thinking about what measure is going to be useful for me in thinking about how much I should pay, what the level, how should the multiple change if I move from, say, an EBIT to an EBITDA measure. Just to flag where we're going there, probably, and you can tell me if this is the case for the industries that you work in, probably if you're buying a business outright rather than simply buying a couple of hundred shares, in a business, the most common, so as in we're acquiring a business as opposed to just kind of buying a few shares in a business, the most common multiple that I see, kind of particularly in recent years, is an EV to EBITDA multiple. So an enterprise value relative to earnings before interest, tax, depreciation, and amortization. So, or it's just an EBITDA multiple is what it's called. That's probably the whole of business equivalent to what we see as a price earnings ratio if we're just thinking about buying equity. So I said, I'll come back to that notion. So park that for a couple of weeks. But if we're valuing a whole of business rather than just the shares, EV to EBITDA seems to be the M&A multiple of choice in most industries. If we're looking at buying shares, price earnings becomes the important measure. And if we think about the kind of the payoffs to different stakeholders, if I'm just buying shares, I don't have a claim on the earnings until the interest is paid, until the tax is paid. And I'm interested in including depreciation and amortization because that affects future CapEx decisions and so on. Whereas if I'm just buying the business and I'm, say, private equity firm and I want to buy the business and take it private, I'm not interested in the tax because it will be subject to my group tax. I'm not interested in the interest because I'm going to do my own financing and I'll be able to build that into my financing models, not the businesses. The depreciation amortization may be less important because I want to restructure the business that I'm buying and either include it with my assets or sell off assets that I don't need. So again, depending on how we're using these performance measures. And so I guess the takeaway is they're not necessarily different types of measures, be it within the income statement, net profit, operating profit or EBITDA, or the non-GAAP versus income statement measures. It's not a case of better or worse. It's kind of how are they being defined, and is that the best way of trying to capture the, I guess, the economic construct that we're interested in? Is that making sense? Yeah, as I said, I'll come back to that when we're looking at both our financial analysis and also when we're kind of when we're thinking about multiples down the track. Other issues that we were thinking about. Let me just go back, and I'm now just going to grab the notes and did I not put notes up for this week? No. Oh, that's why I can't. Okay, that's a bit silly of me. Okay, take 60 seconds just to stretch, stretch around, get a glass of water or something, and I will kind of get the notes up quickly on Moodle. Sorry, I'll just hit audio in case I'm muttering away. Okay, we've now got the notes up. Now what to do during week 4, have a look at the notes. Let me just make sure that I have in fact loaded those. Why did that not work?
I can see them, Jeff.
You can see them? Okay, so that's a me problem, not an us problem. Oh, hang on.
Actually, you put 7R3 under 7R4.
4. Yeah, I have. That's very odd. No, I didn't mean to do that. So let me just see if that's the same as what did I in fact put up on 7R3? Oh, hang on. No, it's a different set of notes. Okay, so sorry, the notes so it's the wrong covers title, and I can adjust that, but the notes themselves are different to what I put up under Seminar 3. So let's have a look. I will get them up. I'll change a share, and I'll make sure that I've got the right that I have the right sort of title slide on there. So I haven't updated the title slide when I was adjusting things. Okay, so this is going to be a kind of, I'll run through this quickly because a lot of this we've already covered. So this is Qantas, and this is kind of on one of the early slides on their investor presentation pack. And what they say on the investor presentation pack here is the first, and the number that they always highlight is this measure called underlying profit before tax. And this underlying profit before tax, okay, that's okay. If I go across screens as I'm sharing, it kind of breaks it on Zoom. So underlying profit before tax is our non-GAAP. Our next measure is our statutory profit after tax. So it's a GAAP, but kind of these are not kind of comparable. One's before tax, one's after tax. Then we've got statutory earnings per share. Then we've got an operating margin, but that is a pro forma number. So as I was saying, so I guess two competing arguments. These things are good, or these things are good, better measure of performance. These things are bad, manipulated. So I said this is sort of the research that I did a while back now. It's kind of upwards of 50 to 60% now. So this is going back a decade. The proportion of companies providing these numbers has kind of kept increasing. What we've got in this middle graph here is the percentage of firms where the non-GAAP exceeds the GAAP equivalent. As I said, it's hovering around 60%. So that was the number that surprised me. I expected that to be kind of 90% or thereabouts. And the numbers on the one hand, I was talking about the research was saying that the market responds more to non-GAAP rather than GAAP. The other comments that at least someone had popped up in the chat box was that if we're stripping away one-off items in our non-GAAP numbers, then what we should end up with is a less volatile earnings stream over time. So earnings should be less bouncy. And that's certainly what has been found is that non-GAAP earnings are more persistent. And the way people test this, and you don't need to worry about the sort of the stats here, but what this is basically saying is that I'm going to run a basic regression saying earnings this year on earnings last year. The higher the coefficient that we have here on earnings last year, that means for each dollar of earnings last year, how much do I see in earnings this year? The higher that number, the more persistent the earnings are. So it turns out that non-GAAP earnings are more persistent. They are also more predictable. That is, if I'm trying to forecast next year's earnings, so earnings next year, am I better off having a GAAP number or a non-GAAP number? And it turns out that even if I'm forecasting GAAP earnings, I'm better off being given a non-GAAP number because it is more reflective. It's going to get me closer to predicting next year's GAAP earnings. So non-GAAP earnings more persistent, and also non-GAAP earnings are better for predicting future earnings, both non-GAAP and GAAP, which kind of, that one might be a bit counterintuitive. So if I was predicting GAAP earnings, I might be tempted to say, well, GAAP earnings kind of this year is the best starting point for GAAP earnings next year, but it's actually not. The non-GAAP earnings does a better job of predicting. One way of thinking about, I guess, in terms of the where would we be looking in terms of this idea of GAAP versus non-GAAP and what are we going to exclude? So if we're thinking about kind of this earnings quality and managing earnings more generally, I mentioned slightly earlier this evening, the idea that we've got, if we're thinking about cash flows versus profit, what we're really doing is what kind of accrual accounting is doing, the accounting stuff that you learned in your AFM classes, is accruals are shifting cash flows into different periods, is effectively what we're doing. So and the argument is that we're shifting cash flows into different periods to get a better performance measure. In the same way that non-GAAP earnings could either be more informative or could be misleading, the argument here is that these accrual adjustments can be more informative or they can be misleading. So if we're thinking about, look, what are the main differences between, so what have I got here? I've got a reconciliation. So a reconciliation of, well, that's not highlighting for me. Reconciliation of cash flows and profit. And this is kind of a footnote disclosure that will appear in kind of ASX listed financial statements and is typically how the cash flow statement is prepared for US firms. This is what's called the indirect method of preparing cash flow statements, if you kind of recall that from the accounting studies. So we start with profit, so profit for the year, and then we make adjustments for anything that affects profit and cash flow differently. So we will, for example, add back depreciation. If we're going from profit to cash flow, we'll add back depreciation and amortization because they are non-cash expenses. So they make profit lower than cash flow, so they will make cash flow higher than profit and so on. But what this list of adjustments is really capturing for us in one spot is everything that makes cash flow different to earnings. Now, when would you be looking at that? You would probably be looking at that in sort of like one of the red flags that pop up if you're analyzing performances. If we have a firm where earnings is kind of going steadily up, but cash flow is going down, that's kind of a bit of a red flag. You kind of want to investigate that. And this kind of reconciliation will help you try and identify what is it that the firm is doing that lets kind of earnings go up and cash flow go down. Because what's happening is that if earnings is going up, but cash flow is going down, then an increasing part of earnings is coming from non-cash backed earnings, if you like. So and we know that the cash component of earnings is more persistent. So yeah, so $1 of earnings this year is more likely to be around next year than if it's all accruals based earnings, which is far more bouncy. So this is one way of thinking about if we're worried about firms managing earnings, yeah, looking at the accruals is one way of doing it. And the way that we can think about this kind of earnings management, if we're thinking about the accruals, it's anything where there's an estimate. So any estimate. So am I estimating depreciation? Am I estimating warranty expenses? Am I estimating how much of accounts receivable is going to be collected? Am I estimating any impairments? Am I estimating the discount rate that I should be using for my long service leave obligations and so on? Any of those sorts of estimates is where you think, well, okay, so here is where I'd be interested in seeing, have these estimates, are they changing in a way that's consistent with what I think is the economic conditions that the firm's facing? And so that's what you can be thinking about for the second part of your project, is to what extent do any changes in the percentages that we're observing, to what extent do they make sense? We often hear that you can trust cash flows, but you can't. You can trust cash flows, but you can't trust earnings because earnings can be manipulated. Anyone that's done any budgeting, think back to when you first started working, particularly if you got paid monthly, you would absolutely remember that you can manage cash flows, because in that last week before you got paid, you weren't going out. You were borrowing sort of $50 off your friend, and yeah, you were eating at home a lot more. So to manage cash flows, we can manage, I can manage sales. If I'm running a business, how can I increase cash flows by what sort of adjustments can I make if I'm doing this adjusting sales aspect of the business?
You can decrease provisions.
So so provisions is probably going to be more on the accrual side rather than the cash flow side. What sort of provisions were you thinking about?
Well, I did Tesla, and I'm from the car industry, and obviously they have to accrue quite a lot for like warranty repairs and things like that from the
correct. Yep.
So you can, it's hard to predict, and I guess, you know, some of them, there's been a lot of stories where they completely miss the mark and their share price has dropped, you know, like GM Motors and Ford back in the day. So I guess from like a viewing perspective, you can say, well, they wanted to increase cash flow, so decided to, you know, based on their estimates, kind of decrease the warranty accruals or whatever else.
Okay, so that's certainly one of the adjustments that you look at, and in businesses like the car selling businesses, and anything that comes with warranties along those lines, is absolutely what you'll be looking really carefully at. What affects our cash flow this period, I guess, is the amount that we need to pay out on a warranty rather than our estimate on future warranties. Is that making sense?
Oh, okay. So you mean like actual, like physical cash flow rather than...
Yeah, correct. So I'm 100% agree that estimating these provisions is something that is absolutely can and has been used to try and hit earnings targets. So it can be used to mislead. It's also just an area with you in a second, Peter. It's also something that it can be used to mislead, but also, as you said, Elena, it's just measured with error. Sometimes businesses can't forecast. I just don't know if I've had a bad batch of cars go off the out of the sales yard this year, and I'm going to be hit with higher than expected warranty expenses in 18 months' time. So it's difficult to forecast perfectly, but we kind of use prior history, industry averages, and so on. Peter, you had your hand up.
Yeah, so Tesla's actually got a really good one for managing cash flows. They took deposits years in advances for cars, so the revenue's completely unearned still because they still haven't produced the vehicle, but they had the cash flows 2 or 3 years ago now. So is that what you're talking about?
Yeah, so they can. So that's managing cash flows by managing to get their customers to fork out the cash earlier than they normally would. Now, that's the sort of thing that we see a lot with, say, the airlines, where you pay for your ticket in advance. It's historically not the sort of thing that we do wholesale with cars unless it's kind of a really limited luxury car that's like the one of 5 that's going to get to Australia, type of thing. Yeah, what I'm also thinking about is if I wanted to get more cash in the door because it was sort of getting towards the end of the month or end of the year, how could I try and increase sales? And let's think about let's think Tesla. How could Tesla increase sales towards the end of the year? But basic eco 101.
Discount.
Discounting, yeah.
Yeah.
I can discount. So I can get more cash in by discounting. Yep, which is fine. So that might get me more cash in. And as long as the discounting is still above my operating costs, I might still be earning a profit on those sales that I'm getting, the discounted sales. But the level of profit, the profitability, the income relative to sales has gone down. So I can manage sales by discounting to try and hit earnings targets is kind of the point that I was trying to make in that slide. Is that making more sense now? Yeah, manage sales by, discounting. I could manage expenses. So if we're thinking about the cash flow management, that has an income statement effect. How can I manage expenses?
You can defer them.
Yeah, look, I had to pay. I was going to do some additional advertising this month, but I will now do that next month. Yeah, so I can particularly defer non-discretionary expenses. So to the extent that marketing and advertising are viewed as non-discretionary, they are kind of a common ones that sort of people play about with. So yeah, just I'll do that. It could be, or so I said, yeah, other ones there, discount for early payments so I can get cash in. And I might just be delaying CapEx, which has implications for depreciation and amortization. And so I guess the point that I'm trying to make on this slide is that we can play about with an earnings number by either kind of managing these estimates, the accruals and the sort of the provisions, how much of accounts receivable when not going to be paid. But I can also play about with, I guess, these are what I would just describe as operational activities rather than accrual estimates is what I've got on the left-hand side, again, to try and achieve an earnings outcome. And so again, why might I be trying to do that? Well, I might be just short of getting my bonus or in danger of breaching a debt covenant or wanting to make my firm look better because I'm about to be purchased or something along those lines. So it's a combination of just be cautious of the claim that you can't manage cash flows because kind of businesses can and do manage cash flows, I guess is the point that I'm making. Look, there are ways of this is kind of like your note here would be on large samples, which is what people look at. The models that people have to try and detect earnings management are, I guess, are what I would call blunt tools at best. What you're thinking about typically in your role as a potential investor or as an analyst, you're kind of looking at a company by company rather than large sample stuff. So it's really if you're looking at, does the suite of accounting and business decisions that appear to have made, are they consistent with what other firms are doing in the industry? Are they consistent from year to year? Or does it look like there's something unusual going on this year as kind of like the firm-specific questions that you're going to be asking? If you're wanting to prepare kind of your financial statements for analysis, then if you think that the rules don't allow your firm to do a kind of a good job of reflecting their underlying economic performance, a couple of options. So one option is, I'm just going to change the financial statements to better reflect what I think they should look like. So if, for example, my business had to expense all R&D and I thought some of the R&D was valuable, as an analyst, I can capitalize some of the R&D. Now that's kind of something that I could do. So I can come up with my preferred method of the financial statements that I will then use as a basis for forecasting. An alternative to this could be I will just try and think through the implications of the bad accounting for the future forecasting. So if we think the accounting doesn't work, as I said, two options. One, make the accounting better based on what we think it should be, use that as our basis. Second, understand the implications of the bad accounting for the forecasting that we will do. And I'll come back to this when we're looking at our ratio analysis and our forecasting in particular, but that's kind of the two of the approaches that you can take, or you could kind of do some combination of that. Because again, where's the endpoint that we're trying to get to is, can we make a reasonable set of forecast about what's likely to happen for our firm? One of the things that we need to think about is, to the extent that the current accounting is suboptimal in some way, what's the best way to correct for that? And as I said, so I guess the standardizing is something that in coming weeks, when we have a look at things like our data analysis database and the FactSet database, that's what the analysts have done in a lot of cases on those databases. They kind of standardize the income statement and the balance sheet so that we do have like for like line items that we're going to be able to compare. The other way is, and this is something that I've been saying for kind of years now, so I'm interested that IFRS is kind of catching on to this, is thinking about trying to get the income statement recast into kind of operating financing, and kind of even more so operating finance and investing activities. So one way, and again, we'll work through some I'll get you to work through some actual examples for this for kind of week 5. Sorry, oh no, will be for next week. Yeah, I'll get you to work through some of this for next week. Is that we can take our net income and we can split that up, depending on how the firm's organized, into our operating items and our financing items. Now, if that's likely to be more informative than just looking at income alone, or income in the way that's presented on the income statement, can we separate out those operating and those financing items? The reason that we're likely to do that is that the operating and the financing items, there are typically different growth and profitability implications for those. And I was getting you to think about for your major project, to what extent would growth and profitability be a reflection of the industry and firm conditions? What we'll then try and think about is, can we get a breakdown of the financial statements that kind of reflects your thinking about growth and profitability and the way in which the firm's going to be financed to get there? So in short, what we're going to be heading to, so where we've got in terms of this recasting financial statements, is, can we take a kind of a sort of complex balance sheet or a sort of complex income statement, group things together in a way that makes sense, which will, one, allow us to get hopefully more informative performance measures when we're calculating ratios, but more importantly, makes our forecasting task easier. Because rather than forecasting every single line item on the income statement and every single line item on the balance sheet, if we can just forecast categories of accounts, that's going to be easier, because there's less things that we need to be thinking about. So as long as we can group like with like, that's where we're heading in terms of the, I guess, both the ratio analysis and the forecasting that we're going through. So as I said, so the aim of that is to avoid having to forecast every single line item that you see on the balance sheet and every single line item that you see on the income statement. Again, is that making sense? Yeah. So in effect, what we'll be doing is analyzing and then forecasting a simplified set of financial statements, or a condensed set of financial statements, rather than every single line item. So that's kind of where we're heading. As I said, so and a couple of examples that you can read through in terms of the adjustments that if you think assets are overstated, what can you do? If you think assets are understated, what can you do? If you think liabilities are overstated, what can you do? Or liabilities understated. Again, that'll be subject to your assessment of whether you think whether your firm, it's a combination of the accounting rules that your firm is under and the way in which any discretion is being exercised. And I'll kind of go through that on JB Hi-Fi and can sort of say, look, here's how I've applied that sort of framework to JB Hi-Fi. The other thing that we can do next week is think about, so here's an example that we've got. If we wanted to adjust, let's say Microsoft, we're taking their research and development of $24 billion, which is expensed rather than on the balance sheet. What would it look like if we tried to capitalize some of that? So we can kind of go through that exercise next week, because I'm kind of conscious of time at the moment. So next week where we're heading is we're going to start looking at some performance measurement, some ratio analysis. So thinking about how can we best try and show the extent to which our firm's business strategy is working or not. So how can we go about doing that? So I'll show you both. You've probably seen, at least for a week in AFM, breaking down return on equity using the DuPont method. Does that sound familiar? Yeah, we'll go back and revisit that, and I'll explain kind of why that's a commonly used way of approaching things, other common approaches, and kind of what we might be looking for based on the industry that we're operating in, because different components of our performance measurement are going to be important for different types of businesses. So yeah, so we start our ratio analysis next week. So I said I'll kind of do a first pass at that on JB Hi-Fi and get that up. I'll do that after I've kind of marked the first part of your project. So I know that getting feedback for that is probably the most time critical thing from your perspective. Any other questions on kind of those non-GAAP earnings management, where we're heading next week? All good. Let me hit stop share there. No, otherwise I can hit